Okay, well, welcome everyone to our first session of the year for the Forest and Climate Learning Exchange Series. I'm your host, Kylie Clay. I'm the Associate Director for the Forest Carbon and Climate Program at Michigan State University. And I want to give a quick thanks to our co-host, the Society of American Foresters, SAF. SAF is the national scientific and educational organization representing forestry and related natural resources professionals across the United States. Founded in 1900, SAF promotes science-based, sustainable management and stewardship of the nation's public and private forests. Thank you also to our additional sponsors, NCX and Renew West. So for today's presentation, Tamara Cushing is here to discuss everyone's favorite topic of taxes, tax dimensions of forest carbon projects. So thank you very much, Tammy, for joining us today. For this, well, a really interesting topic filled with all sorts of question marks. So hopefully Tammy will help pose questions and answer questions, and will be interesting for all. So before we get started, I'd like to briefly share a few housekeeping details. First, to automatically receive registration details and information regarding upcoming webinars. If you haven't already joined with us, please join our mailing list by emailing forestc@msu.edu. A recording of this session, along with a copy of the slides, and will be posted to our site. You'll receive an update about that. Today's presentation, as we do all presentations, will be followed by Q&A. So you can use the chat function or Q&A function at the bottom of the Zoom interface to submit your questions at any point during the presentation. We collect those questions during, and we'll do our best to address as many of them as possible after. So we'll save your questions for the end, for the last 15 minutes typically, and we'll pose those questions at that time. If you're calling in on the phone and have access to email, you can send your questions directly to forestc@msu.edu, and we also collect them there, and we'll pose them during the Q&A time. Okay, attendees today are qualified to receive a CFE credit from SAF, and the credits will be automatically applied if you've registered for the event with the email associated with your SAF account. If not, contact us. And I think that's all we have for background housekeeping and such. So with that, I'll hand it over to Tammy and let it take it away. Thanks, Tammy.
Great. Thank you, Kylie. Let me go ahead and get this fired up. And if you can confirm you can see that, Kylie?
Yes, looks good.
Thank you much. So today we're going to delve into the tax dimensions of forest carbon management. I'm going to be very clear with you up front that this might pose more questions than answers. So we'll go ahead and get started. Maybe. All right, Kylie, that did not go the way I thought it was going to go. I can't advance, Kylie. Oh, there it goes. My apologies. All right.
Oh, it looks good.
Thank you. So every tax presentation has to start with a little bit of a list of disclaimers. It's just kind of part of what we do. First off, I will say tax law is extremely complex, and all I can do for you today really is provide an overview. There's a lot of details inherent in most tax law. It overlaps with itself. And you'll hear me say more than once, it depends. It's not a very satisfying answer, and I understand that, but it usually is a function of so many facts and circumstances, it's hard to really get into it in a overview presentation. As such, this presentation is for educational purposes. I did my best to provide you the most accurate information, but I don't work for the IRS and I don't file tax returns on a regular basis. So take it for what it is, as educational in nature. The information that I present today is current as of today. Things change. I feel fairly confident that nothing is happening at the federal level today that will impact this. That may not be true at state levels, but if you view this at a later date or print this information off, that information could change at any point. I will tell you that carbon programs are evolving. Every time we talk to somebody in this arena, they're tightening up their program or they're twisting this part of their agreement. And so this is just based on the information that we know as of today. And hopefully those programs will continue to evolve. And then some of these considerations will fold into those agreements in the future. And then lastly, and I say this kind of jokingly, but the IRS isn't really talking about this. I tried to ask questions in a forum with the IRS, in a very small forum with the IRS, and they don't have information on this. This isn't really on their radar yet. I suspect it will be. There are other things that have a higher priority that they are dealing with, and so this has not really been something I could get answers from the IRS on. And then even in the legislative vein, when I've talked to some of our legislators, this really wasn't on their radar. And so they're trying to learn and understand what the carbon arena is like as far as forestry before they can actually do anything regarding tax programs related to it. When it boils down to the state level, I talked to a couple of state officials recently. Their knowledge of how these programs are operating is at a fairly basic level and only to the extent of what they've actually heard from somebody else. And so, you know, when I asked a question, the one told me, well, you know, as long as it's not hampering a harvest, it's fine. And so the only program they had seen didn't restrict the harvest. And so until they start seeing all these different varieties, they don't really have any answers either. And so that's just kind of my standard list of disclaimers for you with regards to this particular program. So let's see what we can do today. So I put up on the screen here for you kind of a carbon credit life cycle, more from thinking through the income process, right? That's really where I'm interested in it. So there's a little bit of lumping here, recognizing that no two programs are operating the same right now. They all have some form of what you see on the screen. The timing may differ, right? They may be lumped together, a couple of these, or split them apart depending on the timing. But basically what's happening is a landowner is going to initiate, somehow reaches out and says, I'm really interested in being in this program. They're looking for information, trying to understand eligibility, right? So from there, they get into conversations with the carbon program regarding taking measurements and doing some calculations. And this is the part where it starts maybe to lump together a little bit, the measurements and the calculation and the credit determination. May happen as an early estimation. I know some programs you put in inventory information, estimation on your property. They give you a quick estimate back on what's out there for carbon, so you have an idea what you're working with and whether you're eligible. But the real work is going to happen when we start getting somebody out there and taking some measurements and calculating the amount of credits that you might have. So that point, that credit determination point, I want you to kind of keep in your mind. However that happens or whatever is lumped in doesn't really matter for our purposes today. Really just want to know when that credit determination happens. Some agreement will be signed with that organization to lay out what you're agreeing to as far as your management, if there's any deferred harvest, what you're going to do or you're not going to do with regards to this carbon program, right? And that's how those credits are going to line up. At some point later, depending on the length of the program, there's going to be some verification and some payments. And so for shorter programs, you're going to see that verification and payment on the back end of the program. Specifically like the 1-year program, you're going to see that. When you get into the longer programs, 20, 50 years plus, you're going to start seeing potentially some verification spots or some monitoring spots along the way to keep track of where you're at, make sure you're in compliance with the agreement, and possibly some of those payments being stretched out through there as well. That's the other important timing point from a tax standpoint, is when are payments happening and when are credits issued. Those are the 2 points that are really important in this diagram. So again, this is general, and there are different programs doing this cycle in a little bit different ways. And I'm not going to pretend to know every iteration of it. But for today, the credit determination and the payment point are what we're really interested in. So once you've decided that you're going to get into one of these carbon programs or are interested in these carbon programs, some questions need to come up, at least they do for me, that are related to taxes. And of course, I always think about the tax implications. So that's why these questions are coming up in my head. So these are the 5 kind of lumped questions we're going to center around today. First, is income taxable? So the income that I get from these programs, is that taxable income? Second, when is the income or the wealth realized? Realized meaning you've gotten something of value, right? You've either got a payment or you've increased your wealth. When does that point happen from a tax thinking standpoint? Third, how is the income going to be taxed, right? So we have a couple of different ways of taxing income. We're going to talk about what that looks like today. Fourth, what about expenses? There are expenses that are going to happen throughout that timeline. And what does that mean for you? And maybe putting an expense in your head that you may not even think of as an expense. And then lastly, what else should you consider? What are the missing pieces that aren't necessarily being addressed here in these other 4? So with that, let's leap off and see what we can get to today. So the first question was whether income is taxable. And I'm just going to go straight back to the federal income tax code here in the United States. By definition of the IRS, that all income from whatever source derived is taxable, unless. So basically, no matter how you get the money, under the table, whatever it is, that is all considered taxable, unless there's some part of the tax code that allows you to exclude it. And we have a limited number of examples of that. One of those being cost share funds, if you get any of that for forest management expenses that you're doing. Some of that can be excluded, and there's a special provision for that. Without that provision, that cost share dollar would be assumed to be taxable. So within that definition, it also includes increases in wealth. And that's going to be something that we're going to talk about in this presentation, is not just the actual income that hits your hand, but maybe a perception of an increase in wealth and when that might occur. So the answer to this question about is it taxable? The answer is yes. Income from carbon payments is going to be considered taxable. That's probably the easiest question that I could address today. Let's tackle some of the harder ones. So when is the income or the wealth realized? So there's 2 pieces. There's realized and there's recognized. Realized is when I get it, and recognized is when I have to actually tell the Internal Revenue Service that I've received that money. So that's that recognition event, right? So with regards to carbon, this is a really good question, and one that unfortunately I don't have a solid answer on. So we start looking at different places where we might get an inkling of an answer, or maybe get some guidance on it. And this isn't something I'm alone looking at. There are other folks working in this arena that are looking. There are accounting firms that are trying to figure out what's going on and how this is going to be taxed. So if we look at the rulings, we can go back to a court case, Roseland Plantation LLC versus the U.S. Fish and Wildlife Service. This was not a tax case. This was regards to some other issue. But the important part of that particular case was they included carbon in the bundle of rights from a property. So when we talk about property, we talk about their bundle of rights associated with it. You hear this with conservation easements often. What's in that bundle of rights, right? It can be development. It's your right to harvest timber. It's the water rights potentially, right? So there's all these pieces that are in that bundle of rights. And this district court ruled that carbon credits were part of that bundle of rights and therefore was considered real property. And so that was a really interesting ruling. Now, just because it happens in a district court doesn't mean it will be upheld at the federal level, which is really obviously where we're most interested, but it's information. The next thing that happened was some private letter rulings exchanged between one of the REITs, which is a real estate investment trust. It's an ownership category that's usually more of the industrial owners, right? So they are investments. The initial ruling on this, the question was about REIT status and what would hurt their ability to be called a REIT and their tax preferred status. And so the important part of this was the IRS initially ruled that there was one transaction, okay? And so let's look at what happens. We go back, I'm going to back up for a minute to that diagram of the way this process looks, right? And I told you that we want to pay attention to when the credits were determined and when the payments occurred, okay? And so in this particular question from the REITs, they talked about the credit determination time and the actual payment or the sale of the credits. And so initially what we heard happen with this private letter ruling was that that was only one taxable event. That the only taxable event was when they actually sold the credits. So that sounded pretty good. That's actually probably what you would like to have, is just that one taxable event. However, they later came back, I believe it was 6 years later, they came back and the IRS said, we changed our mind. This is actually two taxable events. So the first taxable event was when the credits were actually authorized. And so the REIT knew how many credits they had available. And then the second taxable event occurred when they actually sold those credits. And so what we saw happen in that second letter ruling was the IRS said that carbon credits were not real property, nor were they an interest in real property. So that's a really important distinguishing factor when regards to thinking about how that income is going to later be categorized. So now we've got two different decisions. Then we can go and we can look at something that's somewhat similar in that it's sulfur emissions, and there were credits being issued for sulfur emissions. And so that's probably the closest thing we have to carbon credits. And so there wasn't exactly an IRS ruling on it. There was a letter ruling on it, and there was a lot of discussion about it. And what came out of this was that there was only one taxable event occurring. So now we've gone back to this one taxable event. But they said also that the carbon credit was going to be considered capital gains. That's the closest we've heard of that, unless it was inventory. And the way it becomes inventory is if I'm just in the business of selling carbon credits, which is not what most landowners are going to be looking at. So that sounds really interesting and sounds like a really good development and a really good thing we'd like to lean on for carbon credits. However, it's a really different market. This was not a market where we had private people or private organizations buying these credits. This was more of a government program that was happening. There was no end to the credit, that it did not have a useful life. And so one of those pieces we look to for a lot of determinations is how long did the asset live for? Carbon credits have a definitive lifetime. Your agreement lasts for 100 years or 50 years or a year. With the sulfur emissions credits, they didn't have a lifetime on them. They were perpetual, so they went on forever. So it's a different market. So at the end of the day, what do we have? We have disagreements all over the place, and we still don't have any clear picture. So when we start looking at how different accounting firms are approaching it, there have been a couple that have written some white papers and have written some articles in some accounting journals, really trying to take these rulings and put them together with what they know about carbon and come up with some kind of idea of how they think it should be approached. So it's really interesting is these are accounting firms doing this. These are not necessarily foresters or those who are used to working directly with landowners on the ground. And so they're seeing it from a different viewpoint. So their consensus that these are two taxable events. When the credit is issued is one event. So there would be a taxable event at that point, and then there would be a taxable event when the credit is therefore sold. So that sounds really cut and dry. That's where the accounting firms are coming up. If you went to one of these accounting firms, that's how they're going to advise you. That's how they're going to do it. However, what seems to be happening with a lot of the agreements or the carbon programs that a lot of landowners are getting into right now is the timing isn't so cut and dry as this consensus appears. So it sounds like I got a credit issued to me last year. I got so many credits issued to me, and then I'm going to put them on the market and then at some point later sell them. It's not necessarily working quite as clearly as that. And because it's not quite as clear as that, it doesn't quite fall into any of these nice, neat little decision points that we might have had earlier. So in some cases, we have aggregators, right, where they're enrolling landowners into a program, telling them how many credits they might be estimated to have. And then that basket or bundle of credits would then be marketed and sold. There is a program that is actually holding the credit, so the credit never actually goes to the landowner. And so these differences, and sometimes this almost simultaneous issue of credit and the sale of the credit is really muddying the water in this particular case. So I think where we're kind of falling on an answer is that we're going to depend on the wording in the contract. So when you sign an agreement with one of the carbon programs, we're going to have to look at that particular contract and see what it looks like and what does it smell like is actually happening. What's really going on and what's going on? How is the transaction actually happening? Is it two distinct transactions or is it one? And language is going to matter, but it's more than just language. It's what's really happening mechanically. And that's really going to take some digging and seeing how some of these carbon payments will actually flow through the income tax system. So ultimately, as disappointing as this probably will be for many people today, we don't really have a definitive answer other than we know it's taxable. And so the only way to really resolve this is not going to be palatable to a lot of people. You can attempt to get a private letter ruling from the IRS. And so you can request a determination from the IRS about a proposed situation and what they think, how it might be handled. They answer very few of those, probably fewer now than they used to. The other option is to go ahead, file it on your tax return the way you believe it is best going to be handled, or your accountant or tax preparer believes it's going to be handled. If it gets audited and the IRS disagrees, they're going to tell you they disagree. You'll get that ruling against you. You can then appeal it, and then ultimately you can go through the legal system to try to resolve it. That's going to take a long time. It's going to cost money to do it. And so, but ultimately that might be one of the best fixes we get is some kind of precedent from someone. In the meantime, we can wait and see if the legislature will take it up. There have been some calls for some structure around the carbon market, around the way agreements are put together, the terms. There are other people who have no interest in doing that. And so it's going to be really interesting to see if that will be taken up in any way, shape, or form. If it is taken up and any kind of structure gets put to that, then that could give us enough to go ahead and make some decisions on this. So the next question becomes, how is any income that's received going to be taxed, right? So there's the timing issue, and now we have to think about how that tax is going to look, right? So first off, what kind of income is it? Well, we have two kinds of income that we look at in our federal income tax structure. We have ordinary income and capital gains income. Ordinary income is really most commonly known as your wage income, your salaries, and anything that's sold as inventory. So if you think about Walmart, when they sell the t-shirts, anything they have in their inventory, that's ordinary income. Capital gains is what we tend to think of as something that's on a long-term asset that is producing something, right? And so in a lot of cases, we'll see timber taxed as capital gains income. So there's very specific rules on that, and I would encourage you to go look those up if you have timber. But Those are the two main types. The character of the income is really determined first off by the holding period. You have to have it at least a year to qualify for capital gains treatment, assuming it's the type of asset that would get it anyway. And so if you hold it for less than a year, it's automatically going to be, considered, it can be considered short-term capital gains, but it doesn't get a preferred rate. So it really doesn't have any of the benefits. The other thing we consider is the reason that you were holding it. So if you hold something primarily for sale in the ordinary course of business, then it's going to be ordinary income. Think back again to those t-shirts, right? If I hold it as an investment, we'll see that go through as capital gains income in a lot of circumstances. That's kind of generally the rules on that. So what difference does it make whether it's ordinary or capital gains income? Well, there's a couple of really good benefits to it. First off, there's different rate structures, right? So capital gains income has a much lower tax rate, anywhere from 0 up to 20% for the highest income earners, versus ordinary income, which starts from, those dollars that don't get taxed, all the way up to about a 37% income tax rate. And of course, those brackets are moving. They're not exactly tied together. They're definitely considered in separate groups. Secondly, we have the ability to offset gains with losses. So the way the tax code looks at gains and losses is, if I have a capital gain from selling my timber and a capital loss from my stock market portfolio, I can net those unlimited. So I can use as much of my losses to offset as much of my gains, as long as they're both capital. If I don't have any capital gains, I'm limited to $3,000 of losses that can offset gains. So you really want to have them of similar nature. And then finally, there's a self-employment tax that is an additional 15.3% tax that we tag on to income that's ordinary. So if you have income from selling carbon credits and it comes back that it's going to be ordinary income, then you're going to pay your ordinary income tax rate plus an additional 15.3%. So that's not really necessarily great news or something that you want to find yourself in that situation. So that's just tax, that's income in general. Let's think about what this means for the carbon stuff now. So unfortunately, we're back to what I told you what happened at the beginning is I'm going to tell you it depends. We have no federal guidance to know whether this is going to be capital or ordinary in nature. Not only did I try to figure out the timing, but I've also tried to figure out whether it's ordinary or capital. And there was no answer from the IRS at this point on that. So we have no federal guidance on how that's going to be taxed, much less the timing of it. And so now we have to start thinking about what else do we have out there that might help me make some decisions on whether it's ordinary or capital gains in nature. And so one of the things that it's been carbon agreements have been compared to is thinking about an easement. So if you think about that easement again, it has that bundle of rights and you give up some part of that bundle of rights. So let's think about just giving up the development rights on your property. And so you've given up a bundle, a piece of that bundle of the rights, and you do it in perpetuity. That's how you get a tax break, right? So you give it up in perpetuity. And so if we think about that and we compare what we're doing with carbon credits. So if I take the easement test, am I giving up a right for an extended period of time? Or does it look more like a short-term rental that I'm just giving it up for a little bit of time and then I have full use of it? So let's kind of put it to the sniff test on a few here. So if I look at a short-term carbon contract, the shortest one I know of is 1 year in nature. And so when I look at that carbon contract of 1 year, it really looks like a short-term rental, right? I've given something up, but it's only temporary in nature. And so it's likely that this is going to be considered ordinary income because of that short-term nature. Now, I've got no proof of that other than just that gut feeling that this is that short term in nature. Yes, it's one year, and 1 year's my capital gains line in the sand, right? I've got to have it for a year, and we're right at that point. But there could be argument on how much is really given up. Again, thinking back on the federal government, how they look at things. Have you given anything up? And so the inclination has been if you give something up for a longer period of time, then you might have actually given up a piece of real property. So this is hard to think you've given up much real property, and therefore it would be ordinary income. The next kind of period of time that I know of one that's out there is kind of thinking of like a midterm. And for a lot of this sounds like long-term, certainly in the South, 20 years would be considered almost a full rotation. A midterm contract, about 20 years. This is possibly, maybe, probably capital gain income. You could certainly make an argument that you have given something up. But again, this is going to come back in my mind to what the contract says. What are you giving up in that 20 years for me to think that you've gotten rid of some kind of real property, right? That you've given up an interest that would be like the sale of an interest of real property. So the more restrictive it is on what you're able to do, the more likely you are to maybe be able to call that capital gain income. And I keep saying maybe and likely, and it's again because we have no guidance. And finally, if I look at that long-term carbon contract, we know that there's one out there around 100 years. This is likely equivalent to an easement, right? Where 100 years, for all intents and purposes, is really almost forever. It's certainly, you're not signing that carbon contract at the age of, a newborn. And so you've really given something up for a long period of time. Again, it depends what the contract is asking you to do, what is in there, right? But it's more like an easement or sale of an interest. And when you sell an interest in your property, we could consider this to be capital gains income. Again, back to what does the contract say? So if we could get the federal government to give us guidance, if all we could get from the IRS is a ruling somewhere that said this was real property, that the carbon credit was real property, and that was an interest in real property, then we should get capital gains treatment. That would definitely make me comfortable saying that for the long term, the midterm, and maybe if we could eke that short-term contract and say it's a year, and the year still makes me a little bit nervous. I tell people a year and a day, but really, I think you might even be able to pull that with a short-term contract at that point. So what about the expenses? Because none of this happens without some expenses inherent in it. There are three ways generally that we handle expenses. We can subtract things from proceeds, sale proceeds. We can deduct it immediately, or we capitalize and deduct it later. And those are things that we see used as like depreciation, amortization, or in case of like a timber sale, something like depletion, right? All those are methods that we would recover our expenses. So a deduction is going to reduce your income, and it results in a tax benefit that's equal to whatever you spent on the expense times the tax rate. So if I'm in the 25% tax bracket and I spend $100, it's going to be 100 times that 0.25. I'm going to get a $25 tax deduction for it. Capitalized expenditures are going to be added to our basis, and then we use them later to reduce the gain. So any gain I have to recognize will reduce by the basis. So just to clear up what that terminology is, the basis is, in the case of an acquisition, I buy something, right? The cost that I had to acquire that property, plus any non-deductible expenses that I incurred throughout the life, minus any amount that I use to offset a gain, or if I have to take a casualty loss or some depreciation, that amount is going to come out of that basis. Okay, that basis number is going to be important for a lot of things. All right, so let's talk about the carbon expenses, and this probably doesn't cover everything. And again, this is just kind of general in nature. If you have exploratory expenses and you don't sign an agreement, so we go through the process of doing a baseline inventory to kind of figure out what's out there, but you then decide not to go into an agreement and you don't use that inventory for any other reason, then we're going to go ahead and deduct those expenses immediately. That would just be what we would consider kind of an exploratory cost. If I do some expenses that I need to do to get enrolled, so I pay to have an inventory done, I get some legal help, all those expenses associated with the enrollment, and I enroll, I sign that agreement, then it's going to become part of my cost basis. And I'm going to hold on to that until another point in time. If I have any direct costs associated with a sale, so best I can do is go back to a timber sale. If I sell my timber and I have to pay an attorney to help me draw up the sale contract, then I'd take that expense of the attorney right out of the sale proceeds. So if there were any direct sale expenses, you would subtract that right off the proceeds. All right, so I told you those expenses that you couldn't deduct right away, we're going to roll into the basis. And so we're going to recover those at the time that the asset is sold. So back to the timing and when is a taxable event? If the receipt of the credit, if the time I get the credit issued is considered a taxable event, then we're going to recover all the expenses that it took to get me to that point. So it would be the fair market value of the credits minus any of my expenses up to that point. And that would be what I would pay tax on. I would have a new basis that would be equal to the fair market value of those credits that were issued at that time. When I sell the credits, whether I already paid taxes on the creation of the credits or not, my basis is going to be recovered as the income is received and taxed. So think of it like depletion on a timber sale. When I sell timber, if I go in and I do a thinning and I thin out a third of the volume, then I would probably take a third of the dollar amount that's in my basis account and use that as an offset. So we kind of think of it similarly. I would assume it's going to be something that we would do proportionate to the dollars that you received. And this is going to be most likely if you're getting those structured payments throughout. If you wait to the end, so if you're in a one-year program and you get all the payment at the end, then you recover your basis against those sale proceeds at the end. Whew, so that was a lot. And so that's just really thinking through the federal income tax part. But there are other things that we have to consider. One of the first things that comes to mind is the state income taxes. And there's 50 states and 50 variations of doing something related to income taxes. Actually, there's less than that. Not every state has a state income tax. So if you're in one of those states that's fortunate enough not to have a state income tax, you can ignore this part. But for the rest of you, there are a couple of different ways we look at the way the state interacts with the federal. The first part would do what we call kind of a piggyback. All 40 states have some kind of linkage point to the federal income tax. It depends on which point they're going to piggyback onto. A lot of them are linking to taxable income. So they go right to your federal income tax form and say, pull that taxable income right into ours, and then we'll adjust from here. Or they go to the adjusted gross income and do the same. 31 states are using federal itemized deductions and pulling those into their and then adjusting at some point. Other states, they have this kind of standalone. They don't use the federal return as any kind of starting point. They just kind of launch off on their own. There's going to be similarities, but there'll be a lot of differences as well. Main point here is even once you think you figured out what to do on the federal level, check on how it might be handled at your state level. They may not even have it on their horizon. They may not even have a clue what's going on, but you need to check and see how they're treating, if they're treating carbon credits at all, have they ruled that it's personal property or real property? All that's going to impact how that looks for your state income taxes. The other piece that we need to talk about is property taxes. So there is been some voiced concerns regarding special use programs. And these special use programs are really programs that think about the value of the land for growing trees instead of taxing it at the full market value or what your house would go for, right? So they're thinking about it really from the use for forestry purposes. So there are programs that have harvest and management requirements that are extremely specific to timber. These are the ones that I would raise a little bit of a red flag with. So I did a quick review, and I'm just going to kind of blow through these real quick. 3 programs that I was aware were pretty timber specific and how they might handle it: North Carolina, Vermont, and Oregon. And the specifics aren't terribly important, but kind of thinking about what their response could be. So when I think about North Carolina, they talk about the value of a tract of land used as forest land based solely on the ability to produce income from timber growth. Okay, does not mean you have to have income every year, but you have to have a timber production orientation. Have to have 20 acres in timber production. And then as you apply to go into the program, the tax officials are looking at your objectives within your management plan to see that commercial timber production is your primary goal. And your written plan has to say how you're going to do it and that what you're going to do to implement. This is important to understand if you're in one of these programs. If you got into this program and you said, I'm in it for timber production, this is what we're a little bit concerned about. You can modify your plan, right? So I can modify my plan and get carbon into there and change my harvest, which might be what I need to do to be in a carbon program. A carbon program may say you cannot harvest like your management plan initially says. We're going to go ahead and change the harvest plan within your management plan. You're going to then need to send that back to the county assessor. That holds true for most states that require a plan. So here's where it gets concerning. So one of the reasons that they would disqualify you in North Carolina is that you are unable or unwilling to follow the recommendations in your plan. Hence why you need to change your plan to say that you're harvesting at a different level, especially when it's pertaining to the harvesting of timber. So this is really, really key. If you're in North Carolina and you decide to sign this contract and you're going to change how much you're harvesting, update your plan, which the carbon program probably will require anyway, and then send it to the county assessor so that you can stay in compliance and be harvesting the amount that you say you're going to harvest. If they disqualify you for not following the rules, it's a rollback provision. They're going to get you on deferred taxes plus interest on the past 3 years. That's going to be ugly. Let's look at Vermont really quick. Yes, I have a thunderstorm if you hear the thunder rolling in the back. Vermont also has a current use program. They enable farm and forest owners who practice long-term management to have land appraised for its use value. And they say it's part of keeping Vermont's working landscape. So they have this idea of we're going to keep people doing things on their land. All land enrolled has to be managed productively, has to have a management plan that includes harvesting timber. Again, not an annual requirement, but it must address harvest of timber. Have to have 25 acres and an approved management plan that's updated every 10 years. I want you to see kind of down below that your primary objective has to be long-term production, but you can do all these other things. You can have wildlife habitat, aesthetics, recreation. They can be acceptable objectives, but they have to be consistent and complementary with timber management. While it doesn't say carbon, you see the etc., I think it's going to follow the same vein. It's got to be consistent and complementary. And so you need to show within your management plan how those two things are working together for a common goal. Sorry, thunder. If you choose not to harvest trees on part of the property, that part of the land will not be eligible And that's a really, really key part if you get into a program that requires you to stop harvesting. Okay, if you change any part of your objectives, you're going to want to do an amended return and send it in. All right, and finally, let's look at Oregon real quick. They have two programs. Both programs really are looking at you growing and harvesting timber. The two programs really differ in one main way, in that one is aimed at smaller landowners, and so they're deferring part of their taxes. So this small tract program is known as a deferral program. And at all times, you have to have enough trees to meet stocking levels from the Oregon Forest Practices Act. So one of the key parts of this small tract is when the landowner harvests. I did say when the landowner harvests, they're going to pay a severance tax. And that severance tax is really meant to make up for all the deferred property taxes over the lifetime of you being in that plan. So they're really going to be interested in making sure that there is a timber harvest planned. So if you get kicked out of the program because you're not complying with the intent of the rules, they're going to also get you for back taxes. Okay, so that's really the important part of this, is all this, especially if you're in that small tract, they're going to roll it back and get you on some of that deferred taxes that you had over time. One of the key questions when you enroll in this program, specifically for Oregon, is any portion of the land subject to a lease, option, or an easement, which permits it to be used for a purpose other than growing and harvesting of trees. Now, that doesn't say carbon, and hopefully nobody would construe it that way. But it's just a piece of a puzzle to think about and keep in mind as you're going through this. All right, kind of wrapping up here, property tax programs. What is the bottom line? Understand what program you're in. I've been in numerous states, talked to folks, and often they don't know if they're in one of these preferred property tax programs. But yet we saw in these 3 states, they're very clearly saying timber must be an objective. And there could be a scenario in which you would be violating the nature of that. Maybe it's just based on an interpretation. If you don't know you're in the program, then you're not protecting yourself against that. So know what program you're in. Before signing a carbon contract, go to your assessor and have a conversation. Show them the contract or the agreement and say, hey, is this going to run me afoul of this property tax program that has benefits to me? Know that this is evolving for them. I talked to some of them within the last 2 weeks, and they were unclear when I asked what happens if it's a reduction in harvest. They weren't sure. They hadn't seen any programs like that, and so they didn't know. Most people that were coming to them had contracts that were not going to substantially change what they were already doing. As some of these programs get in place and people are changing what they're doing, that will potentially get the attention of these property tax programs. Complete restriction. This has been really clear. A complete restriction on harvest will likely result in removal from some programs. Just be aware of that. Convey any concerns you have about this to the carbon program. They're evolving their agreements as well. They're learning. The tax administrators are learning. This is a learning process for everybody. Finally, tax implications, just kind of in general. What is certain today? Carbon payments are taxable. Drop the mic. That I can tell you. They are taxable at this point in time. What is uncertain? Whether there's 1 or 2 taxable events, whether it's ordinary or capital gains, and what impact it has on your property tax programs focused on timber. So all I can say to you today is stay tuned, but don't hold your breath on getting answers. I'm not sure that we're going to have quick answers on any of this, specifically at the federal level. I was clearly told by Democrats and Republicans that they weren't interested in working on this issue right now, and the IRS does not have this on their radar. From a tax perspective, of course, a lot of talk is happening about carbon and carbon markets, but not this particular angle on it. So don't hold your breath on getting a quick answer. hopefully today I've given you at least some things to consider and put that in front of you. So with that, thank you for listening today. And I have some time, I guess, left, Kylie, for some questions that I hopefully can provide some insight on.
Yes, brilliant. Thank you, Tammy. Much appreciated. Those uncertainty categories are large and important. So I'm glad you're bringing this to all of our attention. So I do have some questions for you. Couple of clarification type questions. Well, more broader questions. Is there a difference between income and wealth from a tax perspective? How does that fit in here?
I don't know that there is so much a difference in how it's going to be treated, so much as people don't think of an increase in wealth necessarily as being a taxable event. So if you think back on that issuance of a credit being an increase in wealth, meaning you have something of value even though you don't have cash in hand, that would be the difference, right? I think we all understand if I get paid that I have income, but getting issued a credit may not trigger as that I gained anything, but the IRS is going to view that potentially as an increase in wealth. And now, right now, that's how it looks.
Okay. So carbon credit ETFs, the example given is Crane Shares Global Carbon Strategy, treat carbon credit sales as ordinary income in their own end of year distributions. Does the fact that they do that, that's how they consider, provide any guidance or insight into how the IRS will treat landowner carbon credit sales? So if ETFs are doing that, is that how, is that, is that a precedent of some kind that?
Yeah, it's how they're choosing to do it, right? And so, that means that their folks are looking at it, and that's their best read on it. And if I'm going to be really honest, that's the safest read on it, right? And I say it's the safest read because it's the highest tax rate, right? And the worst position for me as a taxpayer, and the best position for the IRS, right? So if I think like the IRS, they don't care if I report my capital gains as ordinary income. They will not call me on that error. If I report it as capital gains and they don't agree with that, they'll call me on that, and that will be that discussion. So I would love to say that that's precedent. I would say that's maybe it could be a safe read on their part, or it's their best determination looking at the same kind of information that the rest of us are digging on with no real authority on it anyway.
Related to that,
it would have more weight to me if it was audited and or if it went through a court proceeding and we had something for me to point to. But right now I can't point to anything authority-wise.
Sure. Related to that, so there are hundreds of forest carbon projects in the US. Is it safe to say that folks filing their taxes are just, to the best of their knowledge, seeing how it shakes out with the IRS, seeing whether they come back to them? How do you think landowners are grappling with this tax uncertainty? And then related to that, is this a barrier for folks engaging in carbon projects? Like taxes, is the question mark around taxes and the uncertainty around taxes providing a barrier to engagement?
Yeah, so I don't know how people are filing, right? I've had people ask me how to file, and I've talked to some fairly large accounting firms, regional firms. I don't mean to talk like the big five or whatever. It's not those type of folks, but talking to some of these larger statewide regional firms, they're grappling with it themselves. They're coming to the point where they believe it's ordinary income, and that's how they would file for their clients. I don't know how those who are filing on their own are dealing with it, right? I think because of how I know they file in a lot of cases on their timber, because they don't know any different, they put it in ordinary income because they just don't know better. So whether it's a barrier to people getting into the programs or not, I don't know. Do I think it should be? I think it should be a question they're asking, but I don't know that anybody has a good answer for them. I certainly couldn't expect them to ask a carbon program, how will this be taxed? And expect the carbon program to have an answer that the rest of us can't figure out either. So I don't know if it's a barrier. I think it probably should be at least a consideration, is that, you know, it could tax either way. It could tax more than once. I would say the thing that should be more part of the consideration should be the property tax part, right? And I think that's probably what people are not even considering. And that's the one I think they probably should.
You mean the property tax in terms of whether they're eligible for existing tax programs?
Yeah, I think that should be the question they should ask and get an answer to before they go in, more than the income tax consequences, because you're going to pay tax on it. Question is how much.
Right. So to that, well, one question is, so given that there's this, in the tax world, typically this 1 year requirement, you know, this threshold of 1 year, and then beyond that, you can be considered capital gains if it is the type of income that would qualify. Do you think because of that, NCX might, and other short-term developers might extend their 1 year to like 1 year and 10 days or something, so that they can very clearly be on the other side of that threshold? Or, you know, would you advise that from a tax perspective?
You know, that's a really interesting question, you know, because when I talk to landowners about making a decision on harvesting timber, right, and they've held it for a year, I'm like, just go over that year mark, right? And they can do that, right? It's rarely comes down to one day or the other for them. And so we can say, like, just clear the year by a couple of days. And that way there's never any question about timing, because you'd hate to make a mistake and fall a day short. I don't know that I would advise NCX to change on their 1 year contract. You know, it says 1 year, right? So that's a little bit clearer than maybe thinking about that timber sale and when does it start, and when does it official, right? So I don't know that it's going to make that kind of a difference. I think it really comes down to whether their contract or their agreement is viewed as something that is still real property and a real property conveyance that would be capital in nature. I think that's probably the bigger question on that short-term one.
And do you think that, you know, given that you were saying that a big important part of this is it compatible with existing forest tax law and preferential tax treatment in particular? Is there something to short-term versus long-term carbon project contracts that might be more or less compatible with those existing forest tax laws?
Are you talking specifically about property taxes?
Property taxes in particular, yeah.
Yeah, I think that just watching what the rules are in the particular state, right? These states that are, we're giving you a break because we want you producing timber. We're trying to give a timber producer a break. That's where I think I'd be watching it the closest. I think that the states are going to have to decide if this kind of a program violates what their real intent is, especially if it's, you know, I'm in the middle of my rotation in 20 years, I wasn't going to harvest anything anyway. Does this contract really hurt anything for me to go in and restrict my harvesting that wasn't really necessarily a problem? And of course, the carbon agreements don't want that kind of situation anyway, right? And so it's that giving up of harvest rights and how much. And I don't know how much is enough or too much to trigger it. I don't know if I answered your question, Kylie.
I mean, yes. You spoke to the complexities of it in any case, right? As much as there is an answer. So one last question, and then I'll let you go. And is that, are there any obvious tax loopholes that we might anticipate folks taking advantage of? You know, especially larger corporations. Is there going to be an equity question here in the tax space?
You know, I haven't thought about that. I haven't thought through. I don't tend to think about loopholes. Loopholes are, you know, just one of those, you know, we try to make sure people are aware of what the rules are. So I don't tend to deal in loopholes. And of course, the corporate owners have different stakes and have different amounts of money to handle it, and have legal teams to advise them on what's a good loophole and how far they can take it. And so I don't know that I know of any off the top of my head, and I certainly don't advise landowners finding loopholes when they don't necessarily have high-powered legal teams to back them up in their position. You know, you got to ask yourself some days, is it worth the audit? Especially if you can't say I knew better at the end. Sorry, I tend to be more conservative in my approaches to things, especially with regards to tax law.
You just don't want to share your loophole secrets. I see. That's a oh, thank you for that. Okay, well, thank you again to everybody who's come in to hear the presentation today. Thank you especially to Tammy Cushing, University of Florida, for presenting for us this strange opaque world of taxes that maybe I'm just speaking for myself, but need to know more about for sure. So it's been very interesting, and I thank you very much.